It's Monday, June 29, 2026, and welcome to Zoom Out with TouTzuSays. This is my Q3 2026 outlook, the messy middle. But before we get started, remember everything presented here is not investment advice. I'm biased, I have blind spots. This is for your entertainment only. In my last video update, I shared that I expected a long war with Iran, that the warring parties were too far apart to come to a real agreement. Then on June 17th, about 10 days ago, Trump and Iran signed a ceasefire agreement, opening the Strait of Hormuz and setting a 60-day timeline to achieve a formal peace agreement. So where are we now? How's the economy and the stock market? During the week or so that the strait was open, a flurry of ships drove oil tanker traffic back up to nearly 75% of pre-war levels. But since hostilities have resumed a few days ago, traffic has fallen again. Now, as of Sunday afternoon, June 28, it looks like the US and Iran have agreed again to stop shooting at each other. It seems the Iran war and the Strait will continue turning hot and cold, especially since in reality it's a three-way deal that requires Israel to comply as well. In the meantime, new Fed Chair Warsh gave his inaugural press conference and stunned Wall Street with hawkish talk about high inflation and the Fed's unanimous focus on price stability. This is code language for rate hikes in the near future and exactly opposite of what Trump and Warsh were advocating a few months ago. The stock market has been robust leading up to the historic SpaceX IPO mid-June. What may have been lost in the news, however, is that the companies that own ChatGPT, Claude, and Gemini AI are also raising mega billions this year. Meanwhile, the hyperscalers continue to borrow money in the form of corporate bonds in order to pay for their nearly $1 trillion of spending on new AI data centers. The burning question is there enough money to invest in everything at the same time? Or will investors sell something in order to invest in something else, aka rotate their investments? Some on Wall Street are growing very concerned that this can't keep going on. On the other hand, others think that with over $8 trillion in money market funds, investors will simply sell their savings money and invest in these big AI companies that are demanding so much money. I think the prudent thing to do is to monitor the money market fund level and see if they decrease and whether or not the stock market rises or goes sideways in the near future. If money market funds remain at current levels, it's likely that investors didn't sell their money markets and will just rotate their investments, leading to a sideways market. Another important consideration is, what will the government do? In this oversimplified chart, we need to separate the Fed and monetary policy with the Treasury and fiscal policy. The Fed has only two levers: adjusting interest rates and loosening or tightening bank excess reserves through the repo market and discount windows. The Treasury, on the other hand, gets its money from taxes and then directs how and where the government spends its money. If there isn't enough tax income, then they borrow money in the form of selling US Treasury bonds. For this current administration, the Treasury is spending way more than before. One big beautiful bill, AI, energy, mining incentives, and now a big boost in defense spending due to the Iran war is boosting government spending. We clearly don't collect enough taxes to pay for everything, so government borrowing, aka selling US Treasury bonds, will rise. Meanwhile, the AI boom continues in the US with initial public offerings, secondary public offerings, and massive corporate bond issuance collecting money to invest in the AI infrastructure build-out. Right now, with a hawkish Fed, I don't see a lot of monetary stimulus in the near future to help the financial economy and boost stock prices. The Treasury, however, is spending into the real economy, creating economic growth, jobs, etc. Interestingly, what I see is that money raised in the financial economy, which over the last 10 years is often funneled back into the financial economy in the form of share buybacks, is now going to cross over to the real economy, especially in AI infrastructure and defense spending. Net-net, I see a draining of money from the financial economy into the real economy over the next few years. This would be a headwind for stocks. So, what should we expect for the rest of 2026? I think there are four key considerations: whether or not the Strait of Hormuz keeps open, domestic US issues, US China relations, and whether a Super El Nino develops this year. From my previous video, I'm on record that the US and Iran won't come to a permanent agreement anytime soon. I still think a long war scenario will play out whereby geopolitical uncertainty will be reflected in markets. I did add a new sub-scenario, however. I call it a leaky strait. I've come to realize that while neither side can compromise their core positions, allowing a leaky strait provides money for Iran selling their oil and greatly reduces inflationary oil prices that affect the mindset of American voters. By allowing 70 to 80% of traffic through, even occasional saber rattling won't derail the stock market's sentiment. It's a win-win for now, and they can keep postponing the deadline for an agreement without any real consequences. This is now my base case scenario, but the great unknown is whether or not Israel can or will comply. Israeli-Hezbollah peace in Lebanon is a must for a formal peace agreement to be achieved. My bet is, however, one cannot bet on peace in Lebanon. As for the US, I rehash my previous video and simply state that the US will not go into recession in 2026. Fiscal stimulus, the AI build-out will keep the broad economy humming, even if some sectors falter. The US is still facing inflationary pressure in Q3, but has a chance of cooling off in Q4 if the Strait of Hormuz allows 70 to 80% of shipping traffic. It remains to be seen if there's enough liquidity in the system to fund both Main Street and Wall Street. My base case is there isn't. Main Street and the broad economy look to do fine, but Wall Street looks range-bound to me into 2027. This is a rehash of my previous video, but with higher confidence in the long war scenario. If the leaky strait condition holds, we should see inflation go up over the next few months, then slowly come down by the end of the year. I'm expecting at least one rate hike in July or September, then we wait and see how fast oil prices decrease take to affect overall inflation. Remember, however, that the AI boom has triggered another independent set of inflationary prices, especially in memory chips and electronic devices. And if a Super El Nino is confirmed by August, food price inflation will start to appear globally. Given that the US started 2 wars since the beginning of 2026, it's quite impressive that consumer spending remains good despite bottom-dragging consumer sentiment. Lower middle-class Americans are clearly cutting back, but the upper classes, who have enjoyed steady stocks so far, are still spending in the face of higher oil prices and inflation. There are many factors that drive consumer spending behavior, but my guess is that for wealthier Americans, the stock market is the key driver. If US stocks correct or remain range-bound for an extended period of time, I bet overall consumer spending will fall. Right now, home prices are no longer going up, so only stocks are keeping the wealth sentiment lifted high enough for discretionary spending. A reminder that global liquidity has peaked and will likely decline not in absolute value, but in growth rate. The question is, how slow will it grow? Right now, investor sentiment is good, but if a trigger event happens, a declining liquidity environment could mean a bigger correction. We've seen a canary drop dead in the South Korean stock market recently, when the entire market dropped about 10% in a day. Although it recovered, clearly there is high leverage at play. We've seen this movie before, I think spring 2008, and we need to remain vigilant for trigger events that could cause rapid selling. As the second largest economy in the world, China's monetary and fiscal policies are heavyweights affecting global liquidity. This slide confirms that despite deteriorating economic conditions in China, they have withheld liquidity from their economy and markets. Don't know if they have a plan, are holding their fire until they see the whites of the enemy's eyes, or if this is a policy blunder. Regardless, as the second largest impact on global liquidity, China is adding to weakening liquidity environment. Another reminder, the AI build-out is massive, and it's driving 75% of the US economy. All the money raised by the hyperscalers from IPOs and corporate bond sales is funneling into this. Great for the real economy, but it leaves nothing for the share buybacks that have helped prop up the stock market. And with forecast spending for AI capex being adjusted even higher than expected, again, I don't see a US recession anytime soon. So with the AI build-out needing trillions of dollars and the US government borrowing at record levels, with some estimating a whopping 25 trillion in 2026, the liquidity in the market has to go somewhere. In the past, most of the liquidity was recycled within the financial economy through share buybacks and low capex, thus driving stocks and bonds and real estate and Bitcoin up over the last decade. But the environment has changed, and Trump 2.0 has encouraged this liquidity to flow into Main Street rather than Wall Street. With less liquidity in the financial economy, we need to consider the stocks remain range-bound or fall, and we need to be much more selective and active with our investment picks and diversification. Now, a couple of slides of potential downside triggers for the U.S. First, the US-Canada-Mexico trade agreement is up for renegotiation in July. Although Trump has publicly claimed that he wants to kill the USMCA, which he himself negotiated in his first term, the magnitude of a failed agreement would be quite catastrophic and inflationary for the US. Canada and Mexico are the largest trade partners with the US. If cooler heads were involved, I would bet that a slightly modified USMCA would be agreed to in short order. Unfortunately, there's still the risk that Trump listens to the wrong people and is not prepared for the consequences, similar to the Iran war. As I hope Bessent would be much more involved in this than the Iran war, I'm hopeful that the USMCA negotiation will not be an economic and market negative. Regardless, we need to pay attention to the progress on this front. Real estate construction is a major employer in the US, but we're seeing housing inventories rise and prices falling across the country. Some are seeing that as baby boomers downsize or leave the planet, an estimated 250,000 homes are added to the market each year into 2035. Meanwhile, young people are marrying less and later and having fewer kids and require less housing. The simple arithmetic is not looking good for residential real estate for a while. Outside of the US, it all depends on whether or not you're a country that has natural resources or are dependent on importing natural resources to run your economy. North and South America are relatively speaking resource rich. Europe and China not so much. Island nations tend to be very dependent on imports to survive, making most of Asia at risk. Serious headwinds are inflation, scarcity, falling liquidity, aging demographics, and high debt levels. Meanwhile, those nations who can export an important resource will be able to survive, maybe even profit. Given the new world order, according to Trump, the US is no longer the guarantor of peace and freedom, and the world is scrambling to enact national security policies in defense, technology, and natural resources, which should enjoy long-term policy tailwinds. Now let's talk about China. Despite a lot of media about China's near-peer AI prowess, military advancements, EV dominance, and geopolitical credibility when compared to Trump, China faces massive underlying challenges that rival the US. China's economic and demographic boom-bust cycle is eerily similar to Japan's in the late 1990s, and an extended trade war with the US and the West will not bode well for China. Maybe this is a temporary blip, but China's consumer retail spending is its Achilles heel. China makes the best and cheapest goods on the planet, but if the West isn't buying and China isn't buying, Chinese factories have a real problem. China's real estate market, which underpins the majority of Chinese household wealth, has been dismal and hopeless since COVID. They overbuilt in the face of a shrinking population, and foreign investors are all but absent in this market. There's no quick solution to restoring China's property market values. As Chinese households only have 20 to 30% of their wealth invested in stocks, it's no wonder that 70 to 80% of Chinese households with underwater real estate have no appetite to spend. And now fixed asset investments, or capex, has fallen off the cliff. China is famous for overbuilding industrial capacity, especially in top-down incentivized sectors such as solar panels, EVs, rare earths, etc. But overcapacity is now driving those very same sectors into unprofitability. Trade barriers to the West are forcing the Chinese to sell elsewhere, but it looks like the maths is not working. China either needs to prop up more zombie corporations or allow more to fail. And I repeat this chart because it's so important. The old China would pump in more liquidity into its own economy to prevent an uncontrolled economic crisis. I totally thought they would have turned on their money printing press by now. Instead, we're seeing China deliberately withholding this stimulus action. I honestly don't know why, but just note that this is the current reality. Maybe they're trying to train the addict to detox. Maybe they expect relations with the West to allow them to restart massive exports. Maybe they're just saving their bullets for a big, ugly crisis. Whatever the case may be, right now it's tough going for the Chinese economy and for Xi Jinping. Sorry for the horrible screenshot here, but here's the gist. El Nino is already confirmed by global weather agencies. The question is, will it turn into a Super El Nino? As of last week, US NOAA predicts a 63% chance of a Super El Nino and will likely get clarity by August. Although weather is unpredictable weather, the last 5 Super El Ninos all caused major crop disasters globally. Yes, modern technology will mitigate that impact, but generally, a Super El Nino will cause drought in the red areas like East, Southeast Asia, and Africa, and flooding in the blue areas like the US. Crops and food stock will likely be strained and inflationary in a Super El Nino climate. So let's keep watch. And finally, my investment themes for the rest of 2026. First, the liquidity environment and liquidity flowing from the financial economy to the real economy provides a headwind for stocks. I don't think there's enough liquidity to float both the financial and real economies, and the real economy is likely to attract the more money. Under the current conditions, I think this means stocks go sideways and that we will see stock rotation. The frothiest sector is the AI infrastructure sector. I think it has peaked and we'll see investors take profit and rotate into other sectors this summer. I like AI devices like computers and smartphones, robotics, defense, and biotech, which are all AI adjacent but have big performance potential when enhanced with AI. Second, the US national security policy is also the national security policy for the rest of the world. Everyone needs self-sufficiency in defense, energy, metals, chips, etc. Over the next decade, everyone will try to develop their own strategic reserves and competencies. All of this will require more natural resources. Thus, we can't neglect the commodities and the commodity producer nations. Finally, I'm preparing for a Super El Nino. This is not in the mainstream mindshare, which gives it an outsized upside potential if it happens. Meanwhile, in this messy middle of an unresolved Iran war, a new Fed creating monetary policy uncertainty, and a tightening liquidity environment about to unfold, I think it's prudent to also expand the portfolio weighting of income-generating investments as well. All right, that's all for now. Hope you've been entertained and moved to think. Thanks again for watching, and feel free to share this video and reach out to me with your thoughts and questions. Happy trading.